Welcome to this explainer. Today, we're unpacking a piece of legislation that acts as the ultimate financial safety net for everyday depositors. We're looking at the DICGC Act of 1961, or the Deposit Insurance and Credit Guarantee Corporation Act. If you have a bank account, well, this is the invisible shield protecting your hard-earned money. It's quite literally the last resort of the common man.
Okay, let's dive into this by asking a pretty terrifying question. If your bank collapsed tomorrow, would your life savings just disappear? I mean, picture it. You wake up, check your phone, and see on the news that the institution holding your entire life's work has just gone under. It's an absolute nightmare scenario, right? But the reality of how your money is actually protected is a totally fascinating story of financial engineering.
So, let's start with part 1, the nightmare, when banks fail.
Let's rewind a bit. Back in 1960, the Indian banking system faced a massive crisis. We saw the collapse of the Palai Central Bank and then the Laxmi Bank. And these weren't just isolated incidents. They threatened this massive systemic contagion. People were panicking. It caused a truly traumatic loss of public confidence. That very real risk of a systemic domino effect happening across the country led directly to the rapid enactment of the DICGC Act in 1961.
Which brings us to Section 2, the financial safety net.
The government's solution to all that panic was the DICGC. It's a wholly owned, compulsory subsidiary of the Reserve Bank of India. And what's actually super fascinating here is that India was a global pioneer. We were literally the second country in the entire world, right behind the USA, to introduce a deposit insurance scheme to protect small depositors and stop that deadly systemic contagion in its tracks. Now, what's really interesting about this slide is you might be sitting there wondering, okay, how much is this insurance actually costing me? The answer is absolutely nothing. It is completely free for you, the depositor. Instead, the banks themselves are required to pay a premium, which is currently set at a microscopic 12 paisa for every 100 rupees of accessible deposits per year. The banks foot the bill so you can have peace of mind.
Moving on to Section 3, is your money protected?
So, what exactly falls under this shield? If you have a regular savings account, a fixed deposit, a current account, or a recurring deposit, both the principal amount and the interest are perfectly safe. But look at what's statutorily excluded over there. Deposits from foreign governments, central or state governments, interbank deposits, or deposits received outside India. The legal goal here is laser-focused, guys. It's designed to protect the everyday citizen, not massive institutional or foreign funds.
And here is the absolute magic number you need to remember: 5 lakh rupees. As of 2026, this is the hard ceiling. It's the absolute maximum limit of insurance per depositor per bank. So, whether you have 2 lakhs or 20 lakhs sitting in a failing bank, the maximum guaranteed rescue amount you will ever receive from the DICGC is exactly 5 lakh rupees.
So the crucial point is really understanding how this 5 lakh limit is calculated, which brings us to the aggregation and clubbing rule. If you have multiple accounts, let's say a savings account and an FD, in different branches of the exact same bank, the law views you in the same capacity. Those accounts are clubbed together and your total insurance across all of them is still just capped at 5 lakhs. However, if you hold accounts in different rights, like one is your personal account but the other you hold as a guardian for your minor child, those are legally distinct. They are insured separately, meaning each of those gets its own 5 lakh limit. It's a really vital piece of fine print to keep in mind for your own financial planning.
All right, Section 4, the 90-day lifeline.
Traditionally, the statutory timeline was a bit of a slow process. It worked like this. Step 1, the bank officially goes into liquidation. Step 2, a liquidator is appointed and they get up to 3 months just to compile and submit a master claim list. Then, Step 3, the DICGC has 2 months to pay the funds. Notice a key detail here though. The DICGC doesn't just deposit the money directly into your lap. The money flows from the DICGC to the liquidator, who then distributes it to everyone. But as you can imagine, waiting months upon months for official liquidation is agonizing for families who need liquidity today. You still have bills to pay. Often, before a bank is even officially liquidated, the RBI steps in and places it under all-inclusive directions. Basically, that's a moratorium that freezes operations and completely locks depositors out of their own funds.
This brings us to a massive, total game-changer of an update: the 2021 amendment, specifically Section 18A. Look, being frozen out of your life savings is devastating, so the law was changed. Now, if your bank is placed under a moratorium, distressed families no longer have to wait around for those final official winding up orders.
the DICGC is legally required to make interim payments of your insured amount within just 90 days. It provides immediate, critical liquidity when people literally need it the most.
Section 5. Refilling the emergency fund.
And this brilliantly illustrates a really clever piece of legal engineering called the principle of subrogation. When the DICGC pays you your 5 lakh rupees, it legally steps into your shoes. By doing that, it acquires your exact rights to demand that money back from whatever assets the failed bank has left over.
Section 21 of the Act maps out a super strict hierarchy to make sure this works. Step 1. The liquidator sells off the bank's remaining assets, things like its real estate or its loan books. Step 2. The DICGC exercises what's called its statutory preferential right. This basically means the DICGC gets repaid first for the insurance it just handed out to everyone. It gets to cut straight to the front of the line. Only after the DICGC is fully reimbursed do we move to Step 3, where any remaining uninsured claims, like the balances of very wealthy depositors over that 5 lakh limit, are finally paid out.
Let's look at Section 6, the law in action.
So, just how bulletproof is this? Well, in the 2015 Supreme Court case of DICGC versus Raghupati Raghavan, wealthy depositors actually tried to argue that they should get their uninsured money back before the DICGC was repaid. The Supreme Court entirely shut this down. They stated that the DICGC's right to replenish the fund is absolute. The court firmly recognized that statutory priority. That insurance pool must be refilled first because that pool is what protects the wider banking system and future depositors. Think about it. If the DICGC runs out of money, the entire country's financial stability is instantly at risk.
Let's move to another case and see how this builds, but in a slightly different context. Back in 2016, there was a case involving the Madhavpura Mercantile Bank. A state-level liquidator tried to delay the claims process, essentially hiding behind local cooperative laws. Well, the High Court stepped in and firmly affirmed the supremacy of central law. They ruled that local administrative delays absolutely cannot obstruct a central law that was designed to protect the national financial fabric. The DICGC Act cuts right through local red tape to make sure you get paid. As we wrap up this explainer, I want to leave you pondering the fundamental question right at the heart of this legislation. How do we balance the individual's right to property with the nation's financial stability? Because the DICGC Act perfectly captures that delicate balance, doesn't it? It caps protection at 5 lakhs to ensure the vulnerable are safe, while aggressively reclaiming its funds to maintain systemic stability for the entire nation. It truly is an invisible yet deeply vital pillar of our financial society. Thanks so much for joining me on this explainer, and keep asking questions.